So when we first start talking about liquidity, the assumption is you're a day trader, whether you're a scalper, whether you are a session trader, a intraday day trader where you're trying to do the entire daily range, or if you're just a short-term trader or you're looking to time the market for your longer term swing trade or position trade. All of that is encapsulated in tonight's discussion. So it's not just an intraday chart concept. You can use these concepts to really narrow down the amount of risk, reduce it to minuscule amounts. It doesn't mean it's without loss, doesn't mean that you will have winning trades all the time. It just means that if you understand the concepts I'm covering tonight, you will have the ability to go in and fine tune your risk model, be able to reduce the amount of risk that's associated with your trades, and also time the market. Know where the market's going to go to next. Okay. First session we're going to talk about is the PM session ranges. Okay, and this is always going to be referred to in terms of previous day. Okay, so previous day, we are going to be referring to the 1:30 p.m. to 4 p.m. time window, and this is always in New York local time. Now, I'm saying that because I want you to set your trading view chart to New York local time. I say this as much as I can in all my lectures because I get confused when I talk to people around the world and you're in different time zones, and I have made mistakes in terms of telling them what their conversion would be. So to eliminate all that confusion, if you just simply set your charts to New York local time and look at the charts that way, all the confusion goes away. It's very simple. So PM session ranges, you're looking for the highest high and the lowest low between 1:30 p.m. and 4 p.m. Now, is there any ambiguity there? No. It's very simple, succinct, right to the point. Now, what do you do with it? If you are bullish, okay, and we are trading in close proximity to that range, as we see here, this example here, I'm using the June contract before rollover took place at the time of this recording, and live stream, we are looking at the September contract for the indices for 2023, but I'm showing you an example because this is something that I utilized in commentary, something I used in terms of my own analysis and executions and such. But I want you to understand that when we look at PM session ranges, it is always referred to in regular trading hours. Notice this down here in the lower right-hand corner. Let's make the chart a little bit bigger. So down here in the right-hand corner, that RTH, that's regular trading hours. Now you can toggle this if your membership permits you, but this toggle from RTH to electronic trading hours, ETH, okay, one or the other is going to be utilized. If we're going to be looking for PM session ranges, it's always going to be into previous day. The time window, the amount of time that you're looking inside of, what price range, what high are you looking at ICT, which low are you looking at ICT, regular trading hours, it cuts out all the overnight trading. The algorithm, once we start trading regular trading session hours the next day, it's going to refer back to these specific times and what liquidity exists above and below it. So if we're bullish and we're trading near the opening in this little orange line here that's going to be in every slide, that denotes the 9:30 opening bell. You know, when everybody's on CNBC and they clap their hands, that's when the opening bell occurs for the stock indices and stock market. Now, obviously, they're trading all night long, but that opening window starts that opening range for the next 30 minutes. Where will that usually run for? The high or low? If you're bullish and we take out the PM session low, where it's going to be sell side below that, that's wonderful, because if it's bullish and we have a higher time frame premise that's expecting the market to go higher, how do we know that? That's what I've been teaching you. When I do my reviews or I do my commentary or if I'm pointing to something on Twitter. But if you're bullish and the market drops down below PM session lows, notice that this low here and this low here, That's encapsulated inside of the 1:30 to 4 o'clock New York local time. So below those relative equal lows, there's sell side liquidity. It's really simple. It's simple, isn't it? When you go through the process of listening to me and doing the things I tell you to do, and I justify why you should do all these things, that's the boring parts. The folks that have started making real money, 6 figures, payouts, okay, doctor salaries in a month or less, that stuff comes by listening and practicing and going into their charts and not taking my word for it, but going in and seeing if the things I'm saying are indeed true. This logic, if we're bullish, we'd like to see sell side taken. Why? Because that means that smart money would accumulate those sell side liquidity and absorb it for their buy side. So they're going to treat that sell side as counterparty to their smart money buying. So they're accumulating in the Judas swing. The drop down here just goes into this area here where the liquidity is. So we definitely want to be looking at previous day's session, not just any old high and low, the high and the lows between 1:30 and 4 o'clock New York local time. That's the PM session. That range, the highs and the lows, there's liquidity above and below it. If we're looking for higher prices, we definitely expect it to be running to the buy side. But at the opening, we expect, not always, but we anticipate a run lower, that Judas swing, that every Tom, Dick, and Harry on social media are going to chase that. They're going to think it's breaking the new lows and it's going to keep going lower. No. It's only running down there to take sellers into the marketplace, and they're going to buy them. And then the market runs to the buy side. Now, you could be a trader that simply takes this order here as a long, as a turtle suit. Now, admittedly, this takes a great deal of conviction. It probably won't be the first thing you reach for learning from me. In fact, it took a lot of time for me to trust that idea of buying below old lows and selling above old highs for entries, not targets. It's easy to do it for a target, but it's entirely different. It takes an entire paradigm shift in your thinking to go into the marketplace and anticipate that as an entry. But it can be done, and it takes time. How you get there is you study old moves like this and you journal them. But your model could simply be wait for the sell side in the previous PM session range. If you're bullish, that's your buy. If you're going in, that means that you're expecting the weekly range to expand higher. The draw on liquidity higher on the weekly time frame. We covered all that stuff in the previous discussions. But going down into liquidity like this when we're bullish, we would reasonably expect it to run for what? The buy side. Where? What buy side? What high are you looking at, ICT? That one right there. Why? Because it's inside the range between 1:30 and 4 o'clock. How, pray tell, is that complicated? It's not complicated. And I've taught this ad nauseum over and over and over again. But you're not listening. So I'm taking you by the hand tonight, right into the charts. That way everything is perfectly laid out for you. You have absolutely zero excuses. You have no excuses now to know what I'm anticipating. What range am I looking at? I'm not hiding it from you, folks. I want you to succeed. I really, really want you to succeed. And if you can't learn it from tonight's lesson, I don't know how to do it better than this one.